Good morning, everyone. Welcome to the WBHO interim results presentation for the 6 months ended 31 December 2024. Wolfgang and Andrew will be presenting, so I'm going to hand over to Wolfgang.
Thank you so much, Donna. I'll cover the operational divisions, the consolidated order book, the pipeline, and Andrew will do the financial review. So if we can move straight on to the operational review, moving on to ESG. Safety is our primary, most important objective, and it is our priority to ensure that everyone that enters our sites is safe and returns home safely to their families each and every day. That's the primary objective in WBHO. We strive to continuously improve our safety culture, which I believe has helped us improve our LTIFR to 0.17 and our TRIR to 0.16. Sadly, though, we did have a fatality on one of our projects in KZN. All ISO certifications have been maintained across all regions, and there have been no reportable environmental incidents in this time. I'm glad to say that our internal audits show a very high level of compliance. Moving on to building and civil. Our building and civil division increased their revenue by 8%, which is consistent with elevated levels in the second half of FY23. We recorded a 14% increase in operating profit at a margin of 4.7%, which is up from the 4.4% achieved in the comparable period last year, but slightly down compared to the second half of FY24. The buildings increased their revenues by 4% off the back of 19% growth in the Western Cape and KZN, but the market has been softening somewhat in Gauteng, with fewer opportunities around. Commercial offices and residential schemes have been the primary source of work, followed by data center and warehousing projects. Our civil division was supported by ongoing mining infrastructure projects and new work at Kusile and Koeberg Power Station for Eskom. We've made some good progress on the 9,500 man camp in Mozambique, but the overall project still remains under force majeure. Work on 2 large-scale solar farms and 3 wind farms allowed us to achieve 18% growth from the renewable energy sector, and there are a whole heap of other opportunities around in the sector. I don't know if we can move to the geographic footprint. This slide shows in which countries we are actively working in, denoted by the red dots, while the blue dots are areas where we're actively pricing projects at the moment. You'll see revenue and profit from cross-border Africa is quite small relative to South Africa's contribution. Just bear in mind at this point in time that we're quite risk-averse when choosing our countries and projects we're going to operate in. And the big thing you have to ask yourself is, will you get paid? Are you going to be treated fairly? And are your employees going to be safe? So we're very conservative when it comes to picking the building work in Africa. Moving on to the order book in building and civil, it's down by 10%, having worked off 45% of the renewable order book in the period. Now, unlike revenue, which sort of increases over a year in a straight line, order book levels can vary considerably. Take Kata South and West, for example, where we have received an early works contract and are the preferred bidder, and financial close is expected by the end of this financial year. That project is 5 billion rands worth, and there's another one of similar scale, also around about the 5 billion rands worth of work. Further, there's projects available in the data center sector, and as we speak, we're working on a tender for a mega data center in Johannesburg, which is also in the order of about 5 billion rand. You know, if you just add a couple of opportunities I'm talking about, that could well add around about 17 billion rand on the order book. So it's not a straight line. You get awarded a big job, there might be a lull for the big, then 1 or 2 big ones might drop, and so it goes. By sector, building work comprises 75% of the order book, with growth from the residential and hotel sectors. There are many opportunities in the Western Cape, while data centers should really support the activity in Gauteng going forward. Opportunities in the education and healthcare sector are also promising, with good prospects in Botswana and Eswatini for our cross-border crew. There are also some proper marine, water, and energy infrastructure projects, opportunities in the local civil engineering market at the moment. And then, of course, ExxonMobil inquiries for gas infrastructure projects up in northern Mozambique are quite encouraging. Opportunities in Madagascar and Zambia have grown and picked up somewhat in the period. Moving on to our Roads and Earthworks division. Our Roads and Earthworks division has had a fantastic half year, growing the top line by 25%, while increasing the operating profit by 56%. Mining and energy infrastructure still form a sizable chunk of the business, while roads have now crept up to 41%. We are busy on a number of large-scale projects for SANRAL, including the Key Ridge project on the N3 and the Mthemtu to Masikaba Bridge road project on the N2. While we're expecting water to increase given the imminent award of Lebolelo's Olifants project. Revenue from the rest of Africa has increased by 7%, albeit that our margin has come down slightly after having experienced a bit of the labor issues on one of our projects in Liberia. Work on our 61C contract to build the platforms for the trains on the LNG project in Mozambique have progressed, but on the flip side, Botswana does remain a bit subdued at the moment. Again, moving to the geographic footprint, Donna, similar to in building and civils, the red dots denote the countries we are active in, while we are trying to make some inroads into the Ivory Coast, where there's some potential work on mine infrastructure there. Onto the order book slide, Donna. Roads and Earthworks order book is up by 8%, having secured 3.7 billion of roads projects from SANRAL, and we were awarded the 2.75 billion Leiden to Camden project in early January, amongst a few other smaller projects that one could add to the order book listed here. As mentioned earlier, we are the preferred bidder on the Lebolelo 5 billion rand bulk raw water project and have started on an early works contract while waiting for the project to get to financial close. Roadworks are now dominating the R&E order book and include work from track in both South Africa and Mozambique, while opportunities from the mining sector have softened somewhat. The pipeline for wind farms remain promising. We are the preferred bidder on one project. We've managed to secure some work in Botswana with some further potential opportunities there. However, the opportunities in Ghana have diminished somewhat given the localization drive there. Zambia has been quiet in the period, but we have recently secured a new runway for a mining house in Zambia. It's a runway for an airport. Moving on to the UK. We have not seen much change in the macroeconomic environment in the UK, with the market still depressed, with few projects being unlocked. Having said that, the Burn Group managed to increase their revenue by 10% off the back of increased activity within Burn Brothers and Elmers, with concrete civil works and rail infrastructure work supporting Burn Brothers, while the renovation cut and carve market is really driving Elmer's numbers. Revenue in Russell's has unfortunately decreased by 33%. That's really as a result of not picking up awards and delayed awards. They have, however, been awarded 2 contracts valued at £15 million for the Village Hotel Group. One of them, the award was in January. Further viewers have also been secured at the Mere Hotel during and after the reporting period. Moving on to the geographic footprint for the UK, Burn Group still focus their efforts in around London and Birmingham, while Russell's cover the northwest, their head office being in Manchester, and also covering Liverpool from there. Moving on to the order book, pleasingly, the UK's order book is up by 44% on the back of awards in Russell's mentioned earlier and 2 decent-sized projects in Elmers. Both businesses are working to convert some PCSAs. In Russell's, we expect to hear the outcome of 2 of them fairly soon. There are opportunities for more rail infrastructure work on HS2, and there are also further opportunities and potential work from waste to energy projects going forward. The hotel and leisure sector remains a good source of work for both Russell's and Elms. As mentioned earlier, they will hopefully convert the 2 PSAs they are currently working on. I'll pass on to Andrew now for the financial review.
Thanks, Wolfie. So I think if I may just begin by saying that I think the strong operational performance just highlighted by Wolfie has produced a positive set of numbers for the group. And I think the business really is starting to tick all the right boxes. From our key financial indicators, revenue growth, we achieved 10.2% in the current period. It's moderated from the 28.7% in the prior period, but it is still 10% growth from an already high base. And so it is still a good achievement for the business. Segment operating margin improved from 4.8% to 5.2%. That's now edging firmly towards the midpoint of the target range. Earnings per share is up 19% and headline earnings up 20%. So that improvement over the 10% top line growth really does reflect that improvement in the operating margin, as well as a good performance on the interest line. And then I think the number shareholders will be most pleased with is a 30% increase in the dividend per share, from R2.30 a share to R3 a share. And that reflects a reduction in the dividend cover down to 3.7 from 4 in the prior period. The net asset value of the business is edging towards 5 billion. This is critical for us in securing increased facility limits in our guarantee facilities and our asset-based finance, which supports the growth in the business that we are currently experiencing. And then cash generated from operations virtually doubled in the period to 1.1 billion, up from 500 million, and we'll have a bit of a closer look at those numbers in a few slides' time. So this next slide really illustrates the growth journey of the business over the last 3.5 years. Back in 2022, that really signified the end of the severity of the impact of COVID. We moved straight out of COVID into a high growth period. We had sharp growth throughout 2023. And I think to grow from delivering 8 billion rands worth of work in a 6-month period to 10 billion in the following six-month period, and then straight after that, 13.4 billion, that really requires a dramatic shift in resources and an increase in resources that did put some pressure in the business over that period. But we can see now that growth has sort of moderated and stabilized over the last 24 months. And I think the business has adjusted to these elevated activity levels. We've got some divisions now with teams coming free and actually actively seeking new work. And then the combined operating margin is now settled at above 5% for the last 2 6-month periods. From a geographic perspective, the majority of the growth is derived out of South Africa, 14% growth in the period, and SA now comprises 70% of total activity undertaken. We had more moderate growth out of the rest of Africa of 9%, supported by the large projects in Liberia, Ghana, and Moz, as Wolfie indicated. The UK was pretty much flat. Again, growth in the Burn Group offset by lower activity within Russell's. But as was evident in that UK order book, we anticipate a better second half for Russell's. From a margin perspective, an improved margin in SA, and that was thanks to the strong performance locally of the Roads and Earthworks division, and then the slightly lower margin coming from the rest of Africa as a total, and again, related to the labor troubles in Mozambique, in Liberia. We have taken the full cost of those settlements in the first 6-month period. And then although the UK margin is aligned with that of the prior year, still above 3%, it is down from 3.4% at June, and really is just the insufficient volume of work flowing through Russell's. In the summarized income statement, just run through it quickly, 14.7 billion in turnover for the 6-month period, operating profit before non-trading items of 762 compared to 636. The share-based payment expense increased from 34 to 67, and that really reflects the impact of a higher share price on the share incentive schemes. The improved order book levels within Russell's avoided any further impairment of goodwill in the 6-month period, but we will need to sustain that procurement activity over the second half. Profits from associates, that was slightly lower at 34 million compared to 40, and we did experience some lower profitability within Gigawatt, within the Gigajoule group of companies, and really that stemmed from a breakdown of one of the engines at the power station and some planned maintenance as well. Net finance income is nicely up at 113 million and consists of 139 million of interest received, which reflects the higher cash balances of over 4 billion and then lower interest paid of 28 million. And that's really due to the lower Standard Bank debt in the system over the period. Tax of 237 million gives a profit after tax of 605 million and no further expenditure incurred in relation to the discontinued operations. Some of the more material balances in the balance sheet, we can start with property, plant and equipment, continues to grow. CapEx levels remain high at 541 million approved for 2025. We've spent 284 of that, and we have similar levels of expenditure in the year to June 2024. I think the key issue to highlight here is that in previous periods, that spend was really focused towards expanding the fleet, whereas you can see that the focus in the current year is more along the replacement of existing kit over expanding the fleet. We do have 158 million of cash, of CapEx acquired for cash, and that's really directed towards the operations in the rest of Africa. Interest in associates and joint ventures. On this slide, you can see the lower profitability coming out of the Gigajoule group, 40 million in the prior period and 23.3 million in the current period. But the two PPP concessions for government produced 10 million rand in after-tax profits this December compared to 2 million in the prior period. Our investments in property developments, we've got 2 apartments, 2 penthouses at the Trilogy Apartments in Pretoria. These are proving quite difficult to sell. They are both let, and so the rental income is covering the holding costs there. We've got 2 further penthouses unsold at the Rubik in Cape Town, as well as 4 floors of commercial space in that development that we still need to let go. Russell Homes had a quiet 6-month period, but sales did pick up in January and February after the end of the reporting period. Our net deferred tax asset is a large number. In non-current assets, it grew from 518 million to 576 million. We've got tax losses on which deferred tax has been raised, reduced to 12 million, but by far the majority of the deferred tax relates to the timing differences associated with our work in progress and provision numbers, where we're either deferring income or providing for expenditure. So those are just timing differences that wash out over time. Tax through the income statement, if we adjust profits for the after-tax profits relating to the associated companies, those regional tax rates are pretty much where one would expect them to be, 30% in Africa and 25% in the UK. That gives a combined tax rate, 29%, which is comparable with December 23. But down from June 24, where it was 32%, but that included some higher dividend taxation that was incurred when repatriating funds. There's no real significant movement in the long-term debt within the business, no change in our property development funding that relates to the student accommodation building in Hatfield. We are extending the repayment terms of that debt while we wait for the NSFAS debacle to hopefully resolve itself, and we will look to offload that development once the environment is stabilized. Standard Bank debt reduced from 53 to 34. That loan runs out in November 25. The asset-based finance is up, really just in line with the capital expenditure requirements. We've got 3 installments left on the VRP to go. That ends in July 27. And then you can see the impact of the share price on the cash settled share scheme liability, which has increased to 87 million. 434 million of the 670 is sitting in current, in trade and other payables. And then lastly, we just work through the cash performance. We start with an operating profit of 695. After non-cash items, that grows to a cash operating profit of 937 million, up from 789. We've got net working capital inflows of 160 million, which gives cash generated from operations of 1.1 billion, which is in actual fact exceeds the full amount for the 12-month period to June 2024. So a strong cash performance. The working capital flows really comprise of some large movements in debtors and creditors, which just reflects the seasonal adjustment associated with the builders break, where we work less than half a month in December. Contract assets have decreased. The key number in there is the unwind of the milestone revenue. That's set at 314 million in the prior period. That's down to 24 million, but it is still a big number. High levels of materials on site and uncertified revenue. Contract liabilities also increased. That comprised repayment of 228 million in advance payments, but was offset by an increase in excess billings aligned with growth. The last few items through the cash flow statement consist of net finance income of 129 million. We paid taxes of 177 million in the period. The final dividend from the prior period paid in October was 134 million. We had net cash outflows from investing activities of 44. And then the last significant number through the cash flow that needs a bit of unpacking is the 569 million cash flow from financing activities. This number comprises 22 million in bank loans repaid, so largely the Standard Bank debt. 145 million relates to the asset-based finance. And then the bulk of the balance really consists of the purchase of shares for the Offer 21 scheme that vested in November 24, and also purchase of shares of 97 million rand for the Offer 22 scheme, which vests in November 25. So those numbers combined were about 382 million rand, which was a big number. But nonetheless, cash balances settled at the end of the period at just over 4 billion, an increase of 10%. That consists of 2 billion in SA, which was up 9%, 800 million in Africa, which was up 6%, and 1.1 billion in the UK, which was up 16%. So I think overall, a strong cash position that provides good liquidity for the business in all of the regions. Thanks, Donna.
Thank you, Andrew. So if we can move on to the consolidated order book slide. So our consolidated order book is up 7% from June, and essentially it is now back on par with our peak achieved in December a year ago. But as mentioned earlier in the presentation, it can vary, and it is not a straight line calculation. There are a number of real opportunities across all divisions, and some particularly large ones in roads and earthworks and projects specifically, which if awarded will have a considerable effect on our order book. There are potential awards of about 13 billion in R&E and about 9.4 billion in projects. So they are significant projects. That's besides the stuff I mentioned under building and civils in the data center space. So the South African pipeline really remains very strong. The UK is up by 44%. However, the market remains unpredictable. So, unless there's some structural changes there, we don't think there'll be major changes there soon. We move on to the pipeline. When we discuss pipeline, we only include projects that we think will come to market in the next 24 months or so. Building and civil, as you can see on this schedule, there's been a considerable increase from 107 billion to 157 billion, where the huge movements come from additional data centers, healthcare. There's some big stuff in healthcare. Energy is really big still. There are numerous projects in planning in Cape Town. And then there's the Winelands Airport, which is also a mega project, and more projects in water. Retail is still in the decline, together with fewer opportunities in mine infrastructure. Roads and earthworks, we're seeing the roadwork pipeline of work come off a bit, with fewer projects from SANRAL in particular, albeit that 33 billion rand is still a huge number in roads that SANRAL is still going to bring out. So it's still massive. Mine infrastructure is being bolstered up by opportunities on a mega project in Zambia. You'll see the South African mining opportunities have come off, but the overall number has been bolstered up by this project I've just mentioned. R&E are keen to do the runway at the Winelands Airport I mentioned earlier, and water infrastructure is huge at 33 billion. You'll see that it has come off slightly from the last presentation. This is really because we've made a decision not to bid on a certain project and have taken it out of our pipeline. In the UK, the pipeline of work has stayed really flat. Many projects identified in June are still on the list, the same projects. So it has sort of not really moved much. So in summary, if you look at the schedule below, the pipeline of potential available work is significant. I mean, 282 billion rand. And when considering our annual turnover of more or less 30 billion, we should be able to really at least maintain activity levels in the medium term. So looking at the outlook, I suppose the world's quite a crazy place. Today, there's a lot of uncertainty in the world. We have a new era with Trump in charge in the US. And back home, the recent fiasco with the budget creates a whole lot of uncertainty, which is never good for investment or growth. Having said that, we have 32 billion rand worth of orders that we still have to work off, and that will keep us busy for at least the next 18 months or so. There are large-scale infrastructure projects and roads in the renewable sector that will really support us going forward. Our liquidity position and balance sheet are strong, and there are definitely some solid prospects in the African operations over the near and medium term. The UK operations will retain their risk-averse approach to procurement. We believe our conservative approach has kept us whole there. There are many contractors in the UK that have gone into liquidation in the last few months. So I think what we're doing there, taking the conservative route, is the right route. So in summary, I think WBHO is in a very strong position, and we look forward to the next 6 months. In closing, I would like to thank all our employees for their continued hard work. Really, without all our great guys, great people who work for us, none of any of this would be possible at all. And then a big thank you to our clients for their support and trust, and of course, a big thank you to our shareholders. Thank you. Thanks, Donna. Any questions?
So let me just look at questions. Okay. We will take questions now, and we'll basically read them off. There's a link that's been provided for questions. So I'll start with the first few. Lebu Mafokeng from Trafo Asset Management. His comment is, thanks and well done, team. When do you expect further work in the building and civils to be concluded? Apart from the 5 billion Kauta work, you mentioned 17 billion of work.
So, besides Kauta, which is for NOAA, there are a number of large-scale energy projects. I don't want to mention them here all because, I mean, our competitors might be listening too. And the data center space offers a huge opportunity. Just NOAA, the Carter project, that's worth about in excess of 5 billion. The second project I mentioned in the solar space, that's worth about 5 billion. We're tendering a data center now, which a single project is worth in excess of 5 billion. And there are numerous other smaller data centers and other energy projects that make up that number level.
Okay. A second question from Lebu. Your sense on SANRAL rollout of work, has there been a meaningful and encouraging improvement? And then leading on to that, it's the same thing. Your view on infrastructure and expenditure in SA overall.
We've been very fortunate to have secured a lot of work from SANRAL in this period. In the period after December, we got, as I mentioned, a further award of 2.3 billion rands on a project on the N2. So it's very difficult for us to determine the frequency of when SANRAL are going to award. I'm sure they've got their challenges in going through all these tenders. So we've got our fair share and we're quite content. We've got our hands full with Key Ridge. We've got Bishu, it's a mega job. We've got the N2 and we've got Beesterkraal. So we're happy. Of course, we're a big business. We work with 2.5 billion rand every month, so you can never rest. We're always looking for more work. So therein lies our challenge. You know, we're finishing off 2 billion rands worth of work every month. So you need work for those people. And while you're growing, you're fostering, you're growing people, and they'll need more opportunities. And so it goes. We can never rest.
So Ian Reid from Atlantic Holding is asking, when do you expect the tenders to be issued for the Gautrain upgrade? It's
very difficult for us to say. We're not that close to the project, and we wouldn't be able to give you a good, like an accurate indication of when it's coming out.
And if you mean the extension to the line, those are at feasibility stage still. So those are years away, years and years away still.
So Rowan from Cronax Research is asking, is there any residual exposure to Australia?
No, there's nothing left in Australia. We're still pursuing some of the spuriously called guarantees. It's slow progress. We're reaching mediation with some clients. We're struggling to get responses from others, but there's no material numbers in those numbers anyway. So, you know, if something comes through, it will be small.
Isn't back home, you mean?
Back home, yeah.
Another question from Rowan. Is there scope for margin expansion across the businesses? Are you bidding at higher margins in any sectors or regions?
Look, Rowan, what happens when you're quite full? You naturally, let's say when you, it's very different to when you're in a desperate state. When you've got people sitting around, then you need to find work, you'll go in more aggressively. But when you've got a lot of work like we do, you are able to become a little bit more selective. You don't have to chase everything down. And that will naturally sort of tend to a better margin. Then also the balance, if you look at the order book growth, where have we grown in the order book? That will tell you what the margin should theoretically do going forward. Because history will tell you that R&E produces a better margin in building. But we still have to deliver the projects. That's key. You know, at the end of the day, we need to do the work. You know, it's on paper when you secure the work, but you have to deliver that work.
Yeah, I mean, there's some large-scale infrastructure projects that have got a long way to run still. So, you know, some of them will bid in the old sort of regime, and there are some new projects in the newer regime. So there is a blend of margins on the jobs. There's potential, but like Wolfie says, we do still need to bring these big jobs home.
Then Mark Thomas says, in regard to strong cash generation, do you expect working capital contributions to continue in H2? Overall operating cash flow outlook for H2?
Look, the current period we did manage to collect some older debt that was outstanding. So that did assist some of the cash generation in the current period. It's a moving target. It's project specific, but generally the projects run cash positive. I wouldn't expect huge working capital inflows, but if one job, especially on some of the renewables where we sit with milestone revenue, those movements can be significant depending where in the life cycle the project is. But I wouldn't predict any major changes in the second half. There'll be good cash operating profits coming off the jobs, and then the working capital should hopefully remain neutral.
Rowan asks, the equity share scheme settlement was large. Can you expand on this? And will this number reduce going forward?
So I think it was a large number in the current period. It was really the confluence of various factors, all pushing in the same direction. So the number of shares, so the shares were awarded in December 2021. The business had taken a few hits from Australia by that point already, although we hadn't put them into administration yet, but the share price was quite low. The number of awards is really calculated as a percentage of cost to company. So because the share price was lower, the number of awards was higher. Fast forward 3 years, and we've put Australia behind us. We've basically managed through that position. In May, you have new government appointed and positive sentiment in the market. You've got the growth in 2023 that starts resulting in record levels of profitability. So the share price basically shoots the lights out in the last period. So the strong performance meant that we met the performance criteria in the upper levels. So there was high levels of vesting of an already high number of awarded shares. You then had a record share price, so we had to go into the market and purchase those shares that needed to vest at sort of above 200 Rand a share. And when you added all of that together, you ended up with this really significant number for the 2021 vesting. I think 2022, it won't be as dramatic. It's going to start correcting, but I think 2022 offer that vests in the current year will still be a reasonably big number, and then it should start to correct going forward after that. But I think we must bear in mind as well that through the COVID and Australia periods, the levels of vesting and the value of vesting was very, very low for the team.
Marang from North Star Asset Management comments, good morning. You mentioned some capacity freeing in certain divisions. Could you expand on which divisions you're seeing capacity free up in? And then how confident are you that this capacity can be redeployed in the second half?
Look, as I mentioned earlier, you're working off 2.5 billion rands of work every month. So you're looking to place those people that come off those projects every month. So that's just to stay level. Then if you look at the various divisions, particularly the building division in Gauteng, as a case in point, there hasn't been much building work around. They've managed to keep the nose above water by concentrating on data centers. They've been very fortunate to having secured the South African Reserve Bank, which was a mega project, and Stone City. But there's no Reserve Bank replacing that. So they're really focusing on data centers now. And the spare capacity we will send where there's growth. So Cape Town on the other side is showing huge opportunity. There's a lot of work in Cape Town in planning stage. So really now we targeting 1 or 2 projects with staff from Gauteng in the building division. So the same thing applies to the Eastern Cape and KZN. We don't work in silos here. We share resources. If KZN needs work, they'll go to Gauteng. If Gauteng needs work, they'll go to the Western Cape. So there's no barriers between the divisions. A similar, let's say, civils and building and roads and earthworks. So we swap resources in between those. The civil guys might be quiet, but they'll deploy people into the road sector. If you're building heavy concrete structures in civil, you can build a bridge in the road sector. So we're fortunate, there's no silos, we share resources, and R&E share resources in between the divisions as well. As inland gets busy, the guys from the coast come and help. If the coast gets busy, vice versa.
Okay.
So it's quite easy for us.
Another question from Marang. With several projects up for completion by the end of FY25, would you expect full year profits to be more skewed in the second half?
Marang, I mean, it's difficult to give you that kind of forecast into the second half. The order book is there. You can see what needs to be delivered in the column that says what's left to go until June. You know, I mean, if you look at our historical margins and where they're moving, you can make your own assumptions around where you think that's going to go in the second half. There's a bit more work to secure, you know, that's in the office at the moment that would support slightly more than what's in the order book. But yeah, I mean, you'll have to make your own sort of assumptions as to where you think we're going to end up.
Luke from Primary Research. Hi team, congratulations on the results. With regard to Lebalelo, when we spoke last year, you mentioned that its transfer into the order book was imminent. What remains to be concluded before inclusion in the order book? I think you mentioned that financial close was achieved.
No, financial close wasn't achieved. It's really the legalities between Lebalelo and the lenders.
This is a big project finance deal, Luke. So you know, it's a 6 billion rand project finance deal. It's financed half by government and half by the private sector. So working through the legals is currently underway. Made some good progress. We've been talking to the lenders as well. You know, from what they tell us, they're expecting to reach financial close by the end of third quarter, or what would be the first quarter of 2025. So end of March is the current expectation, just to get through all the conditions precedent. But we don't have sight of those. It really is between the lender and the client.
Luke, we have been given an early works contract, so we are proceeding with the design work of the project as we speak.
Mark from SBG Securities, could you discuss your capacity position in SA, people, management, operations to support the buoyant pipeline?
Hi, Mark. So, you know, again, it's depending where the work is, what type of work is. So if you look at solar farms, for instance, we can't take on an endless number of solar farms. We've got teams and a skill set that can maybe do 2 or 3 mega solar farms. If we go beyond that, I think I'll get a bit nervous, and delivery.
We don't have the facilities.
Worry me. The size of the facilities, like Andrew says. But the way WBHO has always operated, we would never take on a project and employ a brand new team. So we bolt on. We'll put the key director in place. We'll put the key operational staff in place, and then we'll bolt on. We are still able to find good people in South Africa. We are employing all the time. Naturally, you won't have success with every person you employ, but we are finding some good guys. So we think, you know, the pipeline is huge. We just want a little bit of that pipeline to keep us going and grow a little bit. So I think we can do it, and we want to grow responsibly. You know, you're not going to see 50% growth or something like that from us. You know, we need the people to deliver the work. If you don't deliver the work, you just need 1 or 2 clangers in the system. That'll wipe out a whole lot of hard work that you've done.
Mark, I think what's assisting the growth is the size of the projects at the moment, some of these infrastructure projects. So there's a number of them, the quantum of large-scale infrastructure projects and the size of the projects themselves. You know, you can run large projects with the same management that's required to run smaller projects. So as long as there's large infrastructure projects in the pipeline, it can support growth. But you're never going to replace those types of projects, a 2 billion rand project with 10, 200 million rand projects. There's just not that kind of work available. So for as long as the projects remain of the scale where they are, then there's potential, and it doesn't, you know, put the same demands on the management as a lot of small projects does.
And then Luke, again from Primary Research, what is the current value of the PCSAs in the UK?
From memory, Luke, it would probably be around the order of 30 million pounds within Russell's. But timing there is something that we can't give any certainty on. Like Wolfie said, we've got projects that were in the pipeline and under PCSA at June that are still under PCSAs at December, 6 months down the track. One of them evaporated, two of them were converted in the 6 month period. We've got two that are with clients at the moment awaiting adjudication. If the pricing comes back as appealing, they'll go ahead with them. If it's not within the feasibilities, they'll get shelved. So it used to be a good indicator of where the business is going, but it's not easy to predict anymore.
So 5 years back, if you were a PCSA, that job was out of the job. Yeah, it's a job now, because we've lost one or two, we're a little bit more.
Lost a couple where we were on the ground already.
Yeah.
And then another one from Luke. Are you still seeing inflation moderating in the UK?
It's not moderating. It's stabilized at about 3%. It remains above the Bank of England's 2.5% target, but it is stable.
So it's very difficult to say. I mean, if you look at projections, what happens in the US, that's a good indicator what will happen in the rest of the world in time to come. But I think in South Africa, there might be a room for a cut given the interest rates versus the inflation level. So if I were a betting man, I'd say maybe there's a bit of a gap.
Yeah. Should get one more cut in here. So.
And then Mark asks, what are you seeing in South African building markets given that commercial building plans advanced greater than 40% in the second half of 24 of calendar year 24?
So the building market, the traditional building market, is all centered around Cape Town. There's so much work there that we're going to be sending staff from KZN and Gauteng to service our good clients there. So Gauteng's quiet. There's hardly any tenders around. PE's quiet. PE's very cyclical. There's a big project over there at the moment, but it's questionable whether it'll actually happen or not. That's the Stellantis motor assembly plant. So it's really focused around Cape Town, the traditional building market where the growth is. If you strip the data centers out of that, Gauteng's big on data centers, but other than data centers, not much. There's bits and pieces. Like we'll get another phase at Stain City, but that's like 200-300 million. That's not in the billions mark.
The educational campus.
Down the line. That worries me a bit, that one, because we have been talking to clients probably 5 years about that one. So
Mikhail from Perspective, I hope I said your name right. Well done to the entire team on a robust set of results and maintaining a strong balance sheet. To what extent is the group exposed to SA government projects other than Sanlam?
We do a lot of work for Eskom. We're currently at Kusile, we're at Medupi, we're at Matimba, at Majuba, we're at Kubu Power Station. So Eskom's a very big client of ours, and Sanlam. SA Inc., we generally work for the larger SOEs. We work for Rand Water. We haven't got anything from them at the moment. We work for Transnet. We hope to secure Berth 205. Get confused with the numbers. That's the berth in Durban. But we generally stay away from the municipalities because experience has told us that payment ends up being an issue.
And then the final question from Irma Venter from Creamer Media. How big is the decline you have seen in activity in Gauteng, and to what do you attribute this?
I think a lot's got to do with semigration to Cape Town. That's my view. I think the traditional building works, hotels, residential developments.
And I think the state of the economy has meant there's been no retail work for many, many years. The hybrid working arrangements stemming from COVID means that there's still an adjustment around commercial office space. I think big corporates are still filling up their offices. They sort of have a part work from home, part in the office. So there's not really a huge demand for office space.
Let's be honest, Cape Town's run better than Johannesburg.
Yeah.
They need to get the ducks in a row in Johannesburg, and maybe the tide will turn and investment will come back here.
All right, thank you.
Thank you, Donna.
That was the last question.
Thanks, everybody.
Thank you.